And a warm welcome to Tax File. I am your host, Lauri Bala Hassan. Thank you for joining us. We begin with a look at the latest developments in the tax space, bringing you the stories making headlines policy. Up next, did you know, where we spotlight key insights and practical tips that could influence your everyday tax decisions. Then we take you to the streets with Vox Pop, capturing real voices and honest perspectives from Nigerians. In the Knowledge Zone, we break it all down, providing context, clarity, and a deeper understanding of the issues. Our Professional Insight segment follows with experts offering clear analysis and practical guidance on complex tax matters. And finally, what's on the net? Your comments, reactions, and conversations from across our digital platforms. Stay with us, there's more ahead. And now, the news. The executive chairman of the Nigeria Revenue Service, Nta Akure, re-echoed that the national single window is being driven by strong presidential leadership and improved coordination across key government agencies. Ejura Etu Opanachi reports.
Dr. Nta Akure noted that the project is fully funded and forms part of a broader effort to modernize government systems. According to him, the platform will not replace agencies such as Nigerian Maritime Administration and Safety Agency, Nigerian Ports Authority, and National Agency for Food and Drug Administration and Control, but will streamline processes by enabling a single point for payments and transactions. Akure emphasized that the goal is to improve ease of doing business, enhance efficiency, and support trade growth. He added that the initiative is ultimately aimed at building a smarter and more coordinated system for Nigeria's economy.
And in a move to deepen collaboration with the private sector, the Nigeria Revenue Service has hosted top executives of Nigerian Breweries PLC at its headquarters in Abuja. The visit provided an opportunity for both organizations to engage on issues around improving tax administration. Evelyn Shija has more.
The delegation was led by the Managing Director and Chief Executive Officer Thibaut Boadon and included the Finance Director Maria Karasewa as well as the Corporate Affairs Director Uzodinma Odenigbo. The visit underscored the importance of sustained engagement between tax authorities and key players in the corporate sector. Discussions during the meeting focused on enhancing tax administration, improving compliance processes, and fostering a more transparent and efficient tax environment. Both parties emphasized the need for continuous dialogue to address operational challenges and align on policy expectations. The engagement also highlighted the role of large corporate taxpayers in supporting national revenue growth and economic stability. The visit concluded with the signing of the Presence Register, a symbolic gesture commemorating the engagement as both organizations reaffirmed their commitment to strengthening collaboration and promoting voluntary tax compliance across the sector.
And that wraps up the news segment. Let's now join Mariam on the Vox Pop segment.
A very warm welcome to you. My name is Mariam Julde Adura. Today, we're out to find out how chargeable gains arising from 2025 are treated. Come. How are chargeable gains arising from 2025 treated?
A chargeable gain arising from 2025 will be assessed and filed under the Capital Gain Tax Act.
From 1st of January 2025 to 31st December 2025, all assets, properties disposed of would be treated and assessed under the Chargeable Gains Tax Act.
Chargeable gain arising from the disposal of chargeable assets from 1st January to 31st December of 2025 will be charged assessed to tax based on the Capital Gain Tax Act.
We'd like to find out how chargeable gains arising from 2025 are treated.
Well, the chargeable gains arising from the disposal of assets from the 1st of January up until the 31st of December 2025, they will be assessed and filed under the Capital Gains Tax Act.
So we want to find out how are chargeable gains arising from 2025 treated.
Well, even though the new laws have taken effect already, effective January 1, 2026, but any chargeable gains from 2025 due to transitional issues are treated in line with the old law, the capital gain tax. It will be charged at 10%. Instead of taking it to assessable profit, it's charged using the old rule.
The future of tax is here. Are you ready? This is Rev 360, a smarter way to manage your taxes. Better efficiency, stronger compliance, and improved taxpayers' experience. End-to-end automation, real-time processing, and seamless compliance. Now all on one intelligent platform. Secure and transparent, no stress, just fast, smooth compliance. Rev 360. This is the future. NRS. Together we rise. Together we prosper.
Did you know chargeable gains arising from disposals made between 1st January 2025 and 31st December 2025 are to be assessed and filed under the repealed Capital Gains Tax Act? For more information, please visit www.nrs.gov.ng.
Ashu Abe takes us on the Knowledge Zone.
Hello and welcome to Knowledge Zone, where we dive deeper into interesting conversations had on the streets. I remain your host, Ashu Abe. On today's episode, we'll be talking about how chargeable gains arising from 2025 are treated under the 2025 Tax Act. Under the Nigerian Tax Act 2025, chargeable gains arising from the disposal of chargeable assets from 2025 are treated as taxable gains and are assessed in accordance with the provisions of Part 8 of the Act. These gains include profits made from sale, transfer, assignment, or disposal of assets, such as land, shares, digital assets, and other forms of property. The gains are now integrated into the general tax framework and are taxed alongside the taxpayer's income or profits for the relevant year of assessment. However, the transitional provisions of the tax reforms clarify that chargeable gains arising from disposals made between 1st January 2025 and 31st December 2025 are to be assessed and filed under the repealed Capital Gains Tax Act, while the new tax administration regime fully applies from 1st January 2026. Failure to properly declare or pay tax on such chargeable gains may attract penalties, interest on unpaid tax, and possible prosecution under the Nigerian Tax Administration Act 2025. Over to you, Lore.
And now to our professional insight segment.
My name is Benedict Hadume-Onyeka. I am the Pioneer Director, Resource Royalty Department of the Service. Before I assumed this role, I was the head of Audit Oil and Gas Services in Lagos. But with the enactment of the new law, that was 26th of June 2025, the new law came into being. So we have the NTA, the NTAA, and then the Nigerian Revenue Establishment Act. All of them came into being on 26th of June. 2025. But in line with the government regulation, it was supposed to be active on the 1st of January 2026. It was meant for seamless transition from the new law, from the old law to the new law, so that people can have enough time to put their acts in order. And that was why they gave a 6 months grace period for people to begin to do preparations. So it's as a result of this new law that gave rise to the creation of a department called Resource Royalty Department of the Service. And I was nominated to be the then acting director, now the director of Resource Royalty Department of the Service. So our core mandate is to organize the implementation of the resource royalty, which includes 4 big functions. It includes, number 1, assessment, collection, enforcement, and above all, reporting of government revenue to the appropriate authority. That is what we do. Under the new law, what we do is we enforce the payment of these taxes by asking or requesting that all companies that engage in whether petroleum or solid mineral, they do what they call monthly filing of returns in line with the law. Now, to be able to do this, because royalty as it were is not a tax, it's a non-tax, so it's included in the revenue that comes to the government as a non-tax revenue. Now, to be able to make this payment, you have to register for royalty and you'll be profiled to be able to make that payment. So when you do that, you file what they call self-assessment. So under self-assessment, the law requires that the taxpayer is to compute royalty payable based on your production, your price, and all the necessary ingredients that will enable you to file to the best of your knowledge. What you have to pay, then you pay. And the law establishes the fact that the unit or the department will conduct a review of what you have done to be able to know whether you have over or underpaid, to be able to give you the appropriate assessment where necessary. So it is the first line is the taxpayer determines what they pay. The second level is the regulator. For the solid mineral, we have the Ministry of Trades and Mines through the minister that issues the price that is used on monthly basis. So if these prices that government issue is what we use to be able to know whether you have filed using the appropriate revenue. Don't forget to take one thing home here. That is to say that every month the taxpayers are expected to file their returns to the ministry using the appropriate department to file the returns for the month under review. And for that month, you're expected to file your quantity of what is sold and what is used for solid mineral. And for the petroleum, you actually file what was produced for the month in question. And the government, they have different units. You have the finance unit, you have the technical unit, and all that. They are the regulator, and they find out what you produce, because they take part in the production and the separation processes. They are always there to know what you produce and what you sell. So our role as the administrator of royalty is to actually take the input from the government agency. For the solid mineral, I repeat, is the Ministry of Solid Mineral. And then for the petroleum royalty is the NUPRC that was formerly known as the Department of Petroleum Resources, GPR. So they give us monthly production, monthly prices, and all relevant information about the equity and all the necessary information that will enable you to verify what you've done. So we don't take part in knowing exactly this is what you have produced or this is what you've used domestically or exported. It is the role of the regulator that does this, and they provide necessary input with the revenue authority. The artisanal miners, they pay royalty, but you may not know. It's only when you come to the process, begin to understudy them and know that they actually pay. But because the artisanal miners, they do not register. You can have a family of 4 or 5 or whatever. They are into mining. They are not registered, but they mine and they have products. So what government did is to say, to be able to accommodate everybody, they form cooperative societies, they form different stratas for people to come in. And so they register this cooperative. And there are other set of people that are registered in the industry, especially for the solid mineral. They are called exporters. They are registered to be able to export products. They don't produce. So what they do is they buy these products from the so-called artisanal miners or illegal miners or any name you call it. They buy it from them at what rate, I don't know. But the law established that these people, to be able to export, you go through the channel of paying exactly what you want to export. There are other processes put in place. Then you pay royalty at that level. What you are paying for are the products you bought from these miners, because government cannot begin to chase people from families and whatever. How many quantity is not possible. There's no technology anywhere that will be able to capture all that. So what government did is to say, as far as possible, you can't go to the ports, whether the seaport or the international airports, to be able to export these products. You will not be able to do it without paying the necessary fee. So everybody that register, either as a producer or as a exporter, you are registered with the tax authority, having your appropriate TIN number. Okay, you pay your tax, do your compliance of withholding VAT and whatever. But for the royalty, you pay your royalty on monthly basis. And for the exporters, even though you export more than 4 or 5 times within the month, they will expect that each time you are going to export, you are going to pay royalty based on the quantity you are exporting. And royalty payment are done seamlessly online, and you get your receipt online. For instance, if you want to make a bank transfer today, you make a bank transfer while in the US, you just do bank transfer and take your receipt, you send it to whoever you have made the payment on behalf of to. And the person can now say that, yes, actually you have made this payment. So what the NRS has done is to create a seamless approach where people can file their return, even from the confine of their sitting room, pay the appropriate fees, and get your receipt seamlessly. So that receipt is just always something that even the government authorities can verify anywhere.
The future of tax is here. Are you ready? This is Rev 360, a smarter way to manage your taxes. Better efficiency, stronger compliance, and improved taxpayers' experience. End-to-end automation, real-time processing, and seamless compliance. Now all on one intelligent platform. Secure and transparent, no stress, just fast, smooth compliance. Rev 360. This is the future. NRS. Together we rise. Together we prosper.
Now, for getting a mining license, the law expects that you're supposed to, number one, register as a company, whether it's any name you call it, mining, whatever, then you register. When you register, you do your homework. Your homework will include getting the relevant data that suits your purpose. What is the reserves that is contained there? There are other scientific studies that you do. You go and do some researches and see whether some people have done it before, but at a stage you'll not be able to get the relevant information that you need. This is what you take forward to a unit that report, though they are self-accounting organization of the Ministry of Trades and Ministry of Solid Mineral. So they are called the Mining Cadastre Office. They call it MCO. Okay, the MCO is like a separate arm under the ministry that handles the licensing of this issuing of licenses. So there are criteria that you go through to be able to get this mineral license. So when you get it, you'll be able to explore. Getting people are different stratas. You get people, yes, they want to join royalty. The word royalty looks beautiful, okay? And two is, are these people really interested? Nobody wants to go into a new stream. It's like you want to go and, clear maybe a forest to begin to erect building. It will take time before you can begin to see results. So how many people are willing to go into this terrain? It was a difficult one. But I had a timeline. Between October, November, December, the law will come into effect January. We have to do high level of engagement section for all the stakeholders. The stakeholders include the NUPROC, the Ministry of Trade and Mine, now the Mining Cadastre, and then you have the OPTS tax at different stakeholders, including the taxpayer on company by company basis, whole lots. And then you needed to do this, you need to do presentation, you need to do technical meetings with nobody. So that staffing issue came up, and gradually today we can say we recorded a tremendous level of success. That's on one side. And the second side is the technology. And the essence of making the new tax law is to bring fairness, simplicity, so that people can stay, like I said before, you can stay in the confine of your house, file your return seamlessly, get the tax law compressed from all those books that we brought it to a very reasonable amount, so that even somebody in secondary school can pick up the Nigerian tax law, read it and understand it without a high level of ambiguity. So NRS has done so well, but doing this is just level one. The level two is to make sure we have technology that could drive this. So what it did is to implement the automation of the payment process. And to automate the payment process, people could sit and say, well, it came like child's play. Never. It was a difficult task to actually ensure that the interpretation of the law, rising from first page to the last page, as it relates to whether petroleum or solid mineral, was put into the tax application, that is the Ref 360 and then the tax promo. So getting it at the back end will work tirelessly throughout the midnight every day because of the timeline, because the law was supposed to take effect from January 1. No excuse. Is to engage the industry, engage the tax, all the necessary stakeholders, and then get this thing implemented on the system. Today, everybody can celebrate it, but it didn't come as quickly as that. It took the grace of God.
Over now to Swateku for What's on the Net.
Good day and welcome to What's on the Net. My name is Joyce Swateku. Asukwa Efyong is asking, good morning all, trust you're doing good. Please, why is ground rent not mentioned among the taxes and its due date not specified? Thanks. Ground rent is land use fee paid by property owners or leaseholders to government authorities like FCTA or state land agencies. It's not classified as a tax under the Nigerian Tax Administration Act, which is why it doesn't appear alongside payee, VAT or CIT. Due dates are set by the relevant land authority and can vary. They are usually announced annually. Non-payment can lead to penalties, interest or even revocation of land titles. In short, ground rent is a land-related obligation separate from statutory taxes, with deadlines determined by the land authority rather than tax law. Oderinde Taiwo is asking, when did you people change the CIT due date to 31st March now? This is so sudden. The Nigerian Revenue Service has not officially changed the corporate income tax deadline to March 31st. What has changed is the broader tax reform effective from January 1st, 2026, which introduced new compliance timelines from various taxes. Under the current rule, CIT is still generally due 6 months after a company's financial year end, not automatically on March 31st. Confusion around deadlines has arisen due to tighter enforcement and some state-level extensions for personal income tax. Over to you, Laurie.
Thank you, Swat, for that beautiful segment. That's a wrap on today's episode of Tax File. For more insights and updates, continue the conversation on our social media platforms. I am Laurie Bala Hassan. Thank you for watching. Stay informed and we'll see you next time on Tax File. NRS, together we rise, together we prosper.